Hello, welcome to Introduction to Accounting. This is a beginning of financial accounting, and assumption is you never had accounting before. If you're going to start right from beginning, where we're going to explain what accounting is used for and how it's structured, and move to some of the concepts that later on be developed in the later chapters. First, let's understand why we have accounting and what is the purpose of accounting. A lot of business transaction involve people or businesses transacting with each other, but not all the transactions in business world considered to be an accounting event. One of the examples, for example, we hire a manager who's starting for us in 2 months from now. As far as accounting department concerned, there's really no need for us to do anything in our end. We don't have a payroll due for them yet. We need some kind of business financial impact for that to happen. Now, if the business have sold, for example, a product, now sale have triggers an accounting event. So only selected transactions or events would be considered an accounting related event, even though it might be still big business event. Once we identify events like receive a ticket, for purchase of a product, sold something, made payroll to the manager currently. Those kind of things would be considered an accounting event and would be recorded and then put it in accounting system. Once all the things been recorded, they would be actually summarized and communicated back to users that will be defining internal and external users. Accounting is a business language of companies, and it's very, very important to understand how the system works in terms of what governs the rules of accounting. External users who would use financial data would be lenders, external auditors, shareholders, board of directors, regulatory customers. And internally, company would use more detailed data to make some business decision. Research and development manager, purchasing manager, how much product should we buy for next month is a planning resource. Human resources based on our current production, how many employees do we need? Marketing manager, production, distribution, and many more. We quantify things in accounting with numbers because we cannot say, well, I made a lot of money last year, or I said I made very little money last year. What does it mean? You say, well, I don't know what is little for you. It might be a lot for me. So we put a number behind any transaction in order to understand and compare and have a data that would be verifiable for us in the future. There's opportunities in accounting. This is where I sell accounting field, or at least get people understand what accountants do. It's a broad field. There's a lot of job opportunities in accounting. I personally came from accounting industry and moved into teaching, but I also did taxation, internal audit. I was chief financial officer. So there's a lot of different things you can do just having accounting degree. So what are they? And people do get specialized. So if you have a doctor, right? We don't have a doctor generalist. We do have that, but then we have more directly related to the problems, and they specialize in that. The same thing we have in accounting. So financial accounting, what do? They prepare financial statements, they analyze transactions, they report internally and externally. They have regulatory requirements they have to report to. Criminal investigation, that's more forensic accounting. Then we have managerial accounting. We actually have a whole class on managerial accounting, and it gets to more analytical side of understanding your cost inside of the company, products that consumer consumes, budgetary issues, treasury, and strategy. So managerial accounting is definitely a very strong, especially in manufacturing industry, presence currently here in Wisconsin as well. Let's get into taxation. Taxation is very wide. I have people ask me a question, oh, you're an accountant, can you please let me know about this? There's a lot of volumes of internal revenue code. I don't know if you're low in there. I would usually have to look it up because they change drastically, but you're dealing with individual tax, corporate tax, partnership tax. It's state planning, right? You have to have some taxation impacts that you look at it. So there's a lot of stuff. State taxation, it's its own specialty as well. And then they have some accounting related. People branch into underwriting, planners, appraisers, litigation support, merger and acquisition. So there's a lot of different things you can do. If you have accounting degree, you can kind of move to other business components. It's harder for a marketing individual to become an accountant, but it's easier for accountant to become a marketing individual because they understand and been trained and how to read the data. Accounting information is all aspects of life. So you might even have non-for-profit. Think about church, hospitals are not-for-profit, colleges. Then we move more manufacturing. Then we go into the service industry. So there, everybody needs an accountant. Even if they don't have somebody full-time staff, they would have somebody even externally that they bring in. And obviously they have a public accounting being contracted. Ethics is very, very important in accounting, and there is actually more and more classes right now just dealing with ethics, because if somebody cannot rely on your data, if there's a fraudulent information that is recorded, public would not invest in you, lenders would not lend you money, and data has to be reliable. So since 2002, there's Oxley Act that's been enforced that require internal audits for quite a few organizations. We're going to talk a little bit about fraud triangle, and unfortunately, as far as this class concerned, we don't get too much into forensic accounting because you have to understand accounting first to know what are things you can do wrong. So we need to understand that frame, but to understand what happens, what puts people in a position where fraud does occur. A lot of times it's actually rationalized. One of the cases we studied early on when I was in school, a gentleman who his daughter needs surgery, and he doesn't have any money, and girl, it's experimental treatment, insurance would not cover it, so he needs $10,000. He's in a position in a company where he can write a check to himself. He thinks he's taking a loan. He repeats the loan later on, and then there's another surgery need to be done. He borrows again, this time a bigger number. Again, it's justified by him because his daughter needs it, right? And cannot pay it back. So you have obviously rationalized financial pressure that he needs it, an opportunity that he has access to money where nobody can verify. So obviously it's not okay to write yourself a check from a company you work for. If they have a loan program, maybe you can look into it. So there's a triangle that exists, and people will take 10 and 20, 30, they get away with that. And it's definitely not okay. We're trying to keep our accounting integrity of our discipline as much as we can, and it happens in every area. Okay. So I'm going to leave this PowerPoint, and you guys can click on this. Unfortunately, with my video, I cannot play other video because you won't hear the sound. So this is the best we can do, but it's kind of fun way of Happy Birthday Oxley song, and it talks about when Oxley is invented and why it was, and it was a 5-year anniversary back in 2007. So it's a fun song just to break up lecture. All right, let's talk about GAAP. So accounting has a rules this way. If I'm in Wisconsin doing my taxes, not taxes in this case, Wisconsin would be different. I'm doing my books, and I'm going to do them in California, I would come up with the same results. So I want to have a relevant information that affects decision of user. So only what is relevant is going to be in those financial statements. It's going to be reliable information, and it's going to be comparable from year to year. You want to have a format that you can compare from one year to another. Then there's also IFRS, International Financial Reporting Standards, and there's also, and it's governed by International Accounting Standard Board, and it's less rigid than GAAP. GAAP is much more tight in terms of rules and regulations. So you might have a company who is operating international and would have to report in GAAP, generally accepted accounting principle, and also do reporting in international financial standards requirements. So accounting has conceptual work or framework that we work with. So we start out with the objective of financial accounting, so to provide information useful to investors. So we want to give them only what they know. They need to know that we sold 3 yellow cars and 20 green cars. No, they might just need to know that we sold 23 cars, or even better, they might just want to know the dollar amount we sold it at. So those type of things, only things that are important and useful to investors, that would be provided. Then we have a quality characteristics, and those include information that's relevant, reliable, and comparable. So we want to make sure from year to year we're pretty consistent how it looks. And we have elements to define items that financial statements can contain. So we do have everything that is required, and we don't come up, oh, maybe we'll just record this. We record everything, and there's a certain format that is actually required that we're going to be learning. And we have recognition and measurement. So we set criteria that item must meet in order to recognize an element and how to measure that element. Okay, so all of this stuff is kind of going under the pillars of GAAP house: measurement, full disclosure, revenue recognition, and expense recognition. And then we're looking at going concern, monetary unit, time period, and business entity. So we're going to talk about each of those separately. They are important, and we're going to keep coming back to them as time goes on. So what is measurement principle? Cost principle. We report everything in accounting based on original cost. So if something went up in value, we still see it on our balance sheet at our original cost, except investments, but that's something we're going to be covering later on. So investments are reported at market value, but adjusted as unrecognizable gain and loss. Here, we just give you end of accounting right here on the first day. What we do, if I bought a building for $500,000 and it's sitting in my books and I'm going to depreciate it, 30 years from now, it's worth $2 million. It's still going to be sitting at original cost minus my cumulative depreciation on the books at the cost basis. This is why, and this is something being discussed back and forth in GAAP, because there's room to report things at market value, but the biggest fear people might increase the number beyond, or it's subjective to the current market conditions. So we do report things at cost principle. Now, matching principle is probably one of the biggest pillars to this building. We say we're going to record revenue and expenses at the same time frame, right? The same time frame that they relate to. So if I sold something, what can I sell? Let's say this pen right here in the month of June, but I purchased it back in January, right? I want to record sale of a pen. Let's say I sold it for $1, I paid 30 cents for it. I want to record $1 minus 30 cents that I paid for it expense in the same time period in June. So I know I made 70 cents on my pen, my contribution margin here, right? So I want to make sure that I push this into the same time period. And in accounting, we have a way of keeping things on hold till things occur. So when I purchased this pen back in January, it's going to sit as an inventory. I'm not going to expense it. And then when time arrives, by the time June arrives, this pen is going to be my cost of goods sold, and it would allow me to close the gap of this time and report my revenue and expenses in the same time period of the month of June. And we'll be talking more and more about this. I just kind of want to make sure we understand what that principle means. Revenue recognition. Accrual basis of accounting. We recognize revenue when it's earned, regardless when goods exchange hands. That is actually in reverse. Regardless when cash exchange hands. So whenever product exchange the goods or services being provided, this is when we recognize the revenue. We don't care when cash exchange hands. So you can have accounts receivable, but you're still going to recognize the revenue. Okay, so revenue is recognized when a title to the goods passed. You can actually claim it as your own. Full disclosure, some things in accounting cannot be disclosed financially, might need to be reported on notes of financial statements. Going concern assumption. Businesses presume to continue operating. So sometimes we'll have a key person in the company that would be retired. And even though financials for this month or this year look good, we need to disclose this so-and-so person who's maybe a pillar to the organization. I'm thinking like opera company. If she would be retiring, it would be a going concern. Can without her representing a company, she still carry her brand. So I'm using this as an example. I'm not sure. So that would be something that you would be disclosing. The key VP have retired. I don't know, a model who sells her brand no longer going to be modeling, or no longer is a company, or sold her company, right? So those things would change how business presumed to continue as it did before. Monetary units assumption. 1 year does not equal $1 or Japanese yen doesn't equal European euros. So in order for us to make things in the same financial statement, we have to bring everything to the same amount. So if it's either US dollar, it's US dollar. If it's euro, it's euro, and so on. Business entity assumption. This is very critical. If you're already a business owner or ever planning to be one, if you own a coffee shop and let's say you own a laundromat, you want to keep your books separate. So when you earn something in a coffee shop, that's where you're depositing in that separate checking account. If I ever have anybody asking me what advice can you give me if I have multi companies, that's the first thing to do. This way you can see how each company is doing. You can analyze it. If you commingling it would be hard to divide things, or you would have to have very good elaborate system that have subdivisions going to it. So if I'm talking about one division of one company, laundromat, let's say, we can account separately from another entities, even if it's the same owner actually. And one owner can own multiple companies and they would want to do that. A time period assumption, the company can be divided into time frames, months, year, quarters, right? So that is important as well. Now, I'm going to let you guys study this, and I don't know if you ever will be taking a business law class. It gets into more details, but each separate entity has its own benefits, and there's the negatives to it. And sole proprietorship, and this is what we're going to start with learning, is a sole proprietorship, even though we're learning rules of corporation, is the one individual usually running the company. And a lot of times from tax perspective, it would be run through Schedule C on their tax return. If we're dealing with partnership, it's 2 or more partners, and it's usually pass-through entity for tax purposes, reported in K1 or 1065 tax return, and each partner would be taxed based on their income level. Corporation, it's its own entity. It almost like has its own tax ID and our social security ID. They'll have their own credit report. You can take corporation and sue them as a corporation because they're their own entity. So you're going to say Case Corporation versus U.S. Environmental Court. I don't know, I just made this up, but you would actually name them in the court proceedings because they're their own entity. You can hold company liable. And then we have limited liability corporation. This governs by laws of state where your limits are. Some businesses cannot be LLCs. You have to have a general partner. So that's all I really want to share this with you. Cost constraints, a little bit about that. All information with benefit disclosure, then their costs need to be disclosed. So if something is not relevant to the business, it does not have to be disclosed. Now, materiality, let's talk about this. I'm going to go back to my pen. So pen is really something I can probably use maybe for 2-3 years. Let's say I'm going to use it for 2 years. So theoretically, I should put this as a fixed asset on my balance sheet and depreciated 50 cents. Remember, it's $1 that I'm the person, let's say, who bought it. So I would have 50 cents every year I'll expense for the pen. But time it takes to record this and keep track of it is kind of counteractive to what the business usually try to achieve. So if it takes you longer to record something that gives you a really benefit, can really 50 cents misrepresent my financial position of a company. This is where we get into materiality option. So we say, you know what, when I bought this for $1, because it's under certain dollar amount, let's say the company, everything under $100, we're going to expense on the year off. You're still going to deduct it because you paid for it. Instead of carrying it on for the life of the asset, you're going to say it doesn't worth our time to spend time keep track of assets under certain dollar amount. So only information that would influence the decision of reasonable person need to be disclosed. So we don't need to disclose that we expense something that should be really depreciated over 2 years if it's not enough to sway somebody's opinion, financial opinion about the company. Okay. This is awesome video that I cannot show you because you won't hear the sound. So you guys feel free to click on this when you're watching this. So Frater, Lucas, Bartolome, I cannot pronounce that, in about minute 12 to 16 and a half. So if you want, you can watch it all 30 minutes. I have quite a few times. Actually came up with a double accounting system. And it's very interesting. Just the whole evolution of it. I always tell students accounting is not math. We just use the numbers because math is, I'm thinking calculus and equation, cosine, sine, and so on. We use numbers to talk about business, but it's not mathematical, natural science kind of equation. However, it was created by a mathematical person to help merchants in Venice to run the business. Very interesting. If you have a chance, watch this video, please. All right. Let's look at main thing that kind of gets us door into the accounting. So in the first chapter, we're going to avoid debits and credits and just going to kind of concentrate on understanding different categories that go into our financial data. So we have assets, whatever we own, liabilities plus equity. So liabilities, we're going to define each of those separately. So let's say I bought a house. House is my asset. Let's say it costs $100,000, and I have $70,000 loan on it, and 30,000 would be my equity. So 70 plus 30 is $100,000 of my assets. So equation equals. And this is what creates double entry accounting that we're going to do a little bit later, but we need to make sure we can get into each category. So what is asset? A car, a building, cash. Cash is like one of the first assets we usually list. Accounts receivable. Let's talk a little bit about that. If I sold something to someone and they cannot pay right away, remember revenue recognition principle. We recognize revenue when it's earned, regardless when the cash is received. So I sold something, right? And I have to recognize my revenue as soon as it happened on that day, but I'm not getting cash. So I'm going to set up accounts receivable as an asset. I have a claim that I can come and collect from you, and that's an asset. Liability, so buildings, furniture, this is all assets. Liabilities, things that you owe to somebody else. Accounts payable, right? Utility payable, rent payable, payroll payable, tax payable, anything you own, notes payable, mortgage. Remember that mortgage for $70,000 that I mentioned? That is your liability. And then whatever you own is the owner's, it's going to be equity. And this equation always have to stay the same. So we're going to expand this a little bit. So my assets are still assets, liability is still liability, and look a little bit more in detail what equity section consists of. Again, we're talking about sole proprietor here, but this later on will turn, it could be stockholders equity. If it's a corporation, it could be partnership equity. If it's partnership, so it's equity is the same concept, it's just who the owners would change the nature of that section, but what is there, it does not change. Okay, so what consists of equity? In equity, we have owner's capital, whatever they put in the business, less owner's withdrawal, whatever they took out of the business. It's not an expense, it's money they just withdrew. And then we're going to add net income. What is net income? Your revenue minus your expenses. So whatever you earn this time period minus expenses increases equity of the company. So we're going to go one by one and go through different transactions. So what I would recommend, I hope you're watching guys the screen because I try to stay a little bit engaged with my hands and everything, but I have very simple notebook here, a pad in this case, notepad, and a pen. When you're listening through those lectures, to stay engaged, to make sure you understand everything that happened, please take a notebook, take a pen, write out what I'm going through, or at least transactions, and then pause it, rewind it. You have this recording to make things a little bit easier for you. That's a good introduction to the chapter before you process stuff into the homework and before the processing of information occurs. By writing it, we memorize things. We actually helps us by taking notes. So I highly recommend it. Pause it anytime you need to. If you feel it's too fast, pause it. Pause it, take your time to make sure you understood it before you move on. All right, so each time we have a transaction, we're going to have to identify what account has to be involved and where does it belong in this accounting equation: asset, liabilities, and owner's equity. So in this case, we have Chase Taylor invest $30,000 cash to start the business name Fast Forward. So we have to think from perspective of Fast Forward. Fast Forward is a company. We're not thinking of Chase Taylor. If we're doing Chase Taylor books, his cash going down. But we're not looking at the books of Chase Taylor. We're looking at the books of Fast Forward. As far as Fast Forward concerned, they receive cash of $30,000, and Taylor capital just went up by $30,000 because he invested money in it. So how would it look in our equation? So we're going to increase cash of $30,000 under asset category, and we're going to increase equity Taylor capital by $30,000 under equity category. And you can see after this transaction, we still have an equal sign here. So you want to make sure we check ourselves after each of them. And in total, they would be the same. Next transaction, and company purchased supplies by paying $2,500 cash. So each time you hear word paid and word cash, right? If they hear word on credit, it's not cash involved, or billed, it's not cash involved. But if you see word cash, it means cash is involved. So cash, what kind of account? Cash is an asset. What about supplies? Supplies and things we own to have a future economic benefit to us. Therefore, assets are supplies, so supplies are assets. And by purchasing them, supplies went up and cash went down. How would we record this? So in accounting, if you have never seen this before, we do put quotes sometimes instead of negative in front of the numbers. The reason we do that is because Excel kind of formats it when you're dealing with accounting things in quotes, and it kind of became natural in accounting, unspoken rule that when things are in quotes, it means negative. When you do assignments in Connect, I think, please read the instructions. Students been telling me it's not always consistent. Sometimes it tells you what to do negative or use quotes to show negative numbers. So please do that to make sure it alleviates some frustration. So we bought supplies for $2,500 using cash. You guys see how everything is one side of the equation? That's perfectly fine. 2,500 negative plus 2,500 positive equals 0. Therefore, our equation is still true. Can we handle this level of math? That's really as much as we're going to see at this point, at least. A company purchased supplies by paying $2,500 cash, making sure the accounting equation might remain in balance, and we also want to make sure the totals remain in balance as well. Next, we're going to purchase equipment for cash. Purchase equipment for $26,000. Cash is an asset, and cash is going to go up. Cash is going to go up. Equipment is going to go up, and cash is going to go down because we are paying for our equipment. So in this case, cash is going down, and we're paying it. It's very similar transaction we just had before, but we're keeping it as separate accounts. So cash negative 26,000, equipment is positive 26,000. So if you're thinking of paying money out of your pocket, so make sure that you're envisioning what's going on. So what's nice thing about accounting, hopefully you can appreciate this early enough. At any given point of time, if I walk in the office and say, hey, how much cash do we have right now? I'm thinking of buying another piece of equipment to help us out. You're going to say, we have only 1,500 on hand. We really, after each transaction, can keep track of what we have in each single account. So accounting equation is still staying in balance after each transaction. Now, obviously, we don't have as much cash, 1,500. We just realized that. So we're going to apply supplies on account for 7,100. So when you see word on credit or on account, it means you're not paying cash. What are you getting out of this? You have supplies coming to you, and it's 7,100. And then we have a liability. You have accounts payable for 7,100 that you have to pay later. I want to pause here for a second and talk a little bit about accounts payable. Just historically, what have students told me? Why is payable positive, not negative? I have to pay the money. You're envisioning you paying the money in the future. As of today, you owe 7,100. When you get your credit card bill, right? Say $1,000. They don't say you owe us negative $1,000, right? Tell us your current balance is $1,000. So your current balance in accounts payable is 7,100. It is a positive number, and as you pay it, it decreases that number. Because each transaction equals to each other, you really don't have to recheck yourself. My slide, it does make a point for you to see that after each transaction, your equation would balance out. Now we're going to get into revenues, expenses, and withdrawals. Let's take a look. Provided we finally in business, right? We want to start making money. Consulting services to customer and receive 4,200 cash right away. I'm getting cash. I already provided services. It's not for future, right? Therefore, I have revenue going up. Remember how revenue minus expenses under the section and owner's equity? So we're going to put 4,200 here and recognize cash and the assets right here, 4,200. My equation is equal and my totals are still correct. What if I'm going to pay expense? So expense is things that do not have future economic benefit. So things that I used it and I cannot put as an asset because it's no longer has a value for me in the future. So my phone bill from last month that I paid now is an expense. My utility bill is expense. Now later on, we're going to learn about prepaid expenses. So if something you buy for the future, that becomes an asset. But if it's something you're using right now, it is expense. So in this case, we paid rent for $1,000 and salaries for $700 to employees. So what paid means we're paying cash. So my cash is going to be decreasing, right? Your employees would not take anything but cash probably. Maybe sack of coffee, a sack of salt or something. In old times, people used to pay with salt. But we do choose cash for payment. So cash is going to go down and rent expense is going to go up and salaries expense is going to go up. So this is the same thing. As far as expense concerned, right, that rent just went up. Your total for the year went up. But impact on equity account, it went actually down. So what do we actually, how does it look? We have $1,000 cash less 1,000 expense. 700 cash paid less 700 expense. So as far as equity concerned, remember those codes again. It's a negative number. It went down. What if you build somebody, but they're not paying you right away? What do? We call this on credit, or we see word billed sometimes. Provided consulting services for 1,600 and rents facilities for 300 to customer for credit. Because I'm not paying right away, I cannot increase my cash. So I'm going to increase my accounts receivable. Remember that account where somebody owns me is going to pay me. And I'm going to increase my revenue for consulting and rent. So my accounts receivable went up by 1,900. And you could have done this in two different lines. You could have done 1,600 and 300 as far as total concern. It would not change. And after that, our equation still remains equal. So this equal sign 1,900 equals 1,900 still stays true. Now, client paying me 1,900 for the transaction we just saw. You cannot recognize revenue again. This is one of the biggest mistakes initially I see students do it. When you get your money, you don't get to recognize revenue again. You do not go and rent it out for another $300 for rents and $1,600 consulting services. You have to just to deal between cash and accounts receivable account to recognize the payment being made. So in this case, we have 1,900 cash coming in and your accounts receivable being decreased because they made a payment. Do not recognize revenue again. Remember when we bought supplies and used accounts payable, we're going to do a partial payment. You don't have to pay full amount. We might have some kind of payment agreement with them. And when you pay for something, cash is going to go down and accounts payable will be decreased. That's another word we like to use in order to reflect that. So you have $900 negative cash, less 900. So now if we say, hey, how much do we still own for those supplies? You can look at a balance and you know I own 6,200. And our equation equals as well. When owner withdraws cash from the business, it's not an expense. So we're going to take cash and pay him, so it's negative, and we're going to increase the equity account withdrawal. So it's increasing withdrawal, decreasing equity account, the same impact as expense has on the equity section of it. $200 cash and withdrawal on account would be taken. So here, if you need to pause for a second, we have a full list of transactions that we just went through it, right? 1 through 11. And we have the running total here. You don't have to do this. I think Connect does it for you automatically. If anything, I actually think it makes it a little bit more busy. But the line in accounting means anything above will be subtotaled. So in here, 1,500 plus 4,200 brought you to 5,700. That's a total in cash after that day, after that transaction. You take 5,700 minus 1,000. Now it's just between those two numbers. It's not all of them above because this number includes everything that happened. And you have a running balance of 4,700. As you can see, by us completing all of this, our totals here, right, would be the same. So this is a great way to view everything in one place. And we're going to have some tools later on in general ledger and T accounts to make sure we can do all of this. All right, we're going to move into four, but we're going to actually just concentrate on 3 basic financial statements and relate how they important to our class. We would be doing financial statements all the way through the class, and we'll make sure we keep revisiting. So this is very important. You need one topic to go to another and so on. First couple chapters definitely require you kind of intertwining that information. You can stop video right now and go practice transactions and come back to this to start practicing financial statements. And your homework would be reflecting a lot of that as well. When we report financial statements, there's requirements by GAAP. It goes to Security Exchange Commission. They want to see all 4. There's a requirement how they should report it, what should they include. First statement we usually prepare is an income statement. Income statement has revenue and expenses, and you can have a loss too. Actually, it's not always revenue, and it's a reports for a certain period of time. So let's say for 1 year, and next year we start all over again. So when we do reporting of income, we actually do it for a certain period of time. You can have monthly and quarterly information. Then we work with a statement of owner's equity. Statement of owner's equity explains what happened to the owner's equity from beginning of a year to the end of a year. So we have a beginning equity plus investments plus any income or loss minus any withdrawal. So again, this comes from a period of time. So each year we're going to prepare a statement of owner's equity from beginning to the end. What different on the balance sheet? Balance sheet is pretty much your accounting equation. It's asset, liabilities, and owner's equity. It's like a snapshot, a picture of what's happening during that moment. So balance sheet, as of this day, how much cash do you have? What is your furniture worth? What is your liability? What does your phone bill looks like? So it just takes a picture. It's ongoing statement. So if I go to bed on December 31st and I have $1,000 in my checking account, when I wake up on January 1st, I should have still $1,000 in my checking account. So your ending balance becomes your next year beginning balance. You don't start all over every year. This is not true for income statement and statement of owner's equity, and I'll explain that in a few minutes. And then we have a statement of cash flow. Very important. We have a whole topic just working around statement of cash flow. We're not going to be doing them initially in this class. However, as far as requirement up to this point concerned, you need to understand what the section of statement of cash flows are and what is the purpose of statement of cash flow, because what happens, we concentrate on 3 financial statements. People say, well, there's no 4th one. We don't want you to think that, so we right away making sure you understand there's 4 of them. So statement of cash flow explains what happened with cash from beginning of a year to the end of a year, and you do this once a year. So if I went from $1,000 to $5,000 in a year, and cash balance, I have $4,000 difference. I'm going to explain this in 3 separate sections: operating, investing, and financing. And it's going to give shareholders, external users, information where my money is going. That's as much as I want to tell you now about it. Okay, so what we're going to do, we're going to look at financial statements, and what we're using really, it's another thing is if you want to go back and with your phone take a picture, we're actually going to be using the data from here, and I really want to not to see this part of the menu. Okay, so right, I cannot use my cursor, but if you guys see the balance in the bottom right, well, it comes up. Okay, so revenue 6,100. We have our expenses 1,700. All the numbers down here, minus my menu that is on my way, we're using for our final financial statement preparation. All right, so that's 6,100 right here. This is my total revenue. So I'm preparing my financial statements. Okay, so we have a left and right column here. This is not debits or credits. Some of you had some accounting before. It's just a format. So every company, and this is very important, I used to lose points on exam by not having that, especially in accounting industry. Every income statement, every balance sheet would look somewhat the same. What distinguishes them is a name of a company and a time frame it's for. If it's not there, nobody knows what they're looking at. It doesn't have that information. They don't know. If I'm going to tell you, so-and-so wrote, run 6 minutes a mile, right? And somebody else run 12 minutes a mile. You're going to say, oh my God, the individual who run 6 minutes a mile are doing much better. But what if I tell you somebody who run 12 minutes a mile is a 4-year-old child? Suddenly, right, relevance and context, it changes. So you need to have that information. You need to know what company you're talking to or looking at. You need to know what time frame we are talking about. So left and right. So we start out with the name of a company, the time frame is for. You can have everything in one column, but what we're really doing, we have a subtotal and we push just more summary information to the right. So my total revenue is 6,100. If you want to know detail, you'll move here and see that. And then we have expenses. So we have our expenses listed. We put one line. It means subtotal is coming, and then you have your total amount. You have your revenue minus expenses, and then we have our net income, the total. So we have relevant information on one side. Once we calculate net income, it's the first statement we prepare. We're going to move to statement of owner's equity. And again, this is for this month, so I know what data I'm looking for. This is a brand new business. Remember, we invested at 30,000. So we started with a capital in the beginning with 0, plus investments, plus net income we just calculated. So we need to do this statement first because we're using net income in our owner's equity. Then we have a subtotal of increases, 30,000 plus 4,400, 34,400. This is our total. And last withdrawal by owner, minus 200. So you can see how we summarize it. If they had more than one withdrawals, maybe 5 or 6, they'll all be totaled here. They don't need to know day by day what they took out. We're just looking at a total. So beginning plus owner's investment plus net income, or if it's a loss, it would be a negative number, less withdrawals would be my ending capital in account. Now we're ready to prepare a balance sheet. In the balance sheet, we start out with our cash, supplies. It's all come from totals that we had in our total spreadsheet. We don't need to know all detail of everything happened doing with cash. We have our accounts payable and total liabilities. In this case, we have only one number. Still going to list the number of total. If account is 0, like if you guys remember that accounts receivable that was paid, we don't usually list it. And we have our equity, and equity is a newly calculated equity for previous assignment. So we do need a sequence of doing the financial statements in this order. Income statement, statement of owner's equity, balance sheet, in order to do this. So my asset equals liabilities plus owner's equity. So very happy, it's balanced, and I know I did my stuff correctly. So this is a financial statement, so we'll take some practice. You need to remember to identify where they go. Accounts usually go to only one place. I say usual because net income flows into the owner's equity, and owner's equity flows into balance sheet. Cash only appears in balance sheet. It does not appear in income statement. And rent expense would not appear in any other financial statement. So when you have a chart of accounts, they're going to go to only one place. They're not going to go to more than one place. So you have to identify and make sure you understand what assets are, what liabilities, what would be considered revenue, what would be considered expense. Because when you do that, you know where they're going. And last but not least, we have a statement of cash flow. You just need to understand it exists. And all you're doing is explaining how cash went from 0 to 4,800 between 3 categories: operating, investing, and financing. You would not be required at this point in class to prepare. Now, you guys see how it says December 31st? So it says picture on December 31st. This is what it is. It's not as of or for the months off. All right, we're almost done here. What can we do with the financial data? Well, we can calculate different ratios that we're going to be calculating as we're moving through our material. And the very first one, we can calculate return on asset, or ROA is the abbreviation of it. And what we're going to do, we're going to take net income divided by average total asset. And the way you calculate average total assets, you're taking beginning and ending and divided by 2. So in this case, we could have calculated, right, by looking my total assets, 40,400, because the beginning of the year I just started business. We don't have that number, right? But and we're going to take our net income and we can calculate our return on asset, how well we're doing with our assets. So this is couple ratios here, how Nike is current year is better than previous year. This ratio, higher is better. You better generating more income with your assets. And I think this is a little bit, a couple of years back, I believe Under Armour declared bankruptcy. So this is a couple of years ago, and you could see they were not doing as great. And, that would be a warning sign if somebody would be looking to evaluate this. So I'm going to stop sharing my screen. And I would like to say that feel free to go back to the lecture. I try to do everything in one lecture structure. The reason I do that is that you have one topic in one place, but feel free to pause, rewind, skip ahead if you need to, but the goal is here to give you a feel. If you've been in a classroom, this is something I would be going over with the class, and we'll be doing step by step. Please invest time in these videos. It would save you time on your homework. Thank you, good luck, and practice makes this class absolutely easiest thing you can do for yourself to succeed and have less stress and overwhelmed by information. But one topic by another, and I promise you, it does get easier, but practice definitely something very much required in this course.